In this week's update, a correction playing out in typical fashion, the one we had to have. Australian opportunities are eye-wateringly good. Is this early 2020 revisited? And gold is better, but does it go beyond just the Ukraine? My name's Garry Davis. As always, this is general advice, and please remember to like and subscribe to the video. Pardon me. All right, let's start with some overall perspective. Not a great deal has changed in the last week in terms of direction. In my mind, things have just become a notch clearer and perhaps a notch more predictable, if you can have that in a fairly volatile market. But if you step back from the day-to-day, this really is playing out, pretty much in textbook fashion. Now, for those of you that were in the market in 2020, it was a terrific investment year if you were on top of things. The first thing you need to do was to recognise that the markets had a big problem, and that wasn't hard to do because it was pretty obvious, and you cashed up to a significant degree. And that protected your capital in that plunge through February and March, and left you in a good cash position to then take advantage of the next step. And from the bottom in March of 2020 to about November of 2020 was one of the best investment periods that I can remember in 30 plus years in the market. And I think there's a chance that what we're going through at the moment may set up something similar. It'll never be the same. It'll be probably different sectors and different stocks. I think the stocks that really benefited enormously during that period were the COVID beneficiaries like Zoom and stocks of that nature. So I don't think that's going to happen again. But there will still be tremendous investment opportunities when this correction plays out, be that a few months or perhaps 6 months from now. But you've got to be prepared for the next step. You've got to know what it is you want to buy. You've got to have the plan and the clarity and just the courage to pull the trigger. Because the best times to buy are when everybody is running the other way and no one wants to have anything to do with the stock market. And you'll see all sorts of negatives about the market on the front page of the press. So it's not easy to actually pull the trigger. But if you can do it, then it's just an ideal time to buy. So this correction is likely to set up quite similarly. I don't suspect that it's going to be as dramatic as the COVID crash, because that was the market being broadsided by an unknown. But within the context of what's going on around the world at the moment, I think the setup is going to be quite similar. And the reason that occurs is that human nature responses are just always the same. They never change at the extremes. We're hardwired to react with varying levels of fear and greed. And at the extremes, that's what's going to play out. So that's what sort of makes it predictable with, if you step aside just from the day-to-day backwards and forwards, the trends are pretty clear. And in that process, great stocks get hit as well, just on sentiment. People panic and they just sell everything without regard. And that means that great stocks whose prices are going significantly higher in the next 6 months, 12 months, 2 years, simply get cheaper. And so it allows you to multiply your investment return because you're able to buy into them cheaper, and the price is just going to bounce back to where it was always going to go to anyway. So the bottom line is that you really should be embracing this phase of opportunity. If you're sitting there getting despondent with the market going down, the stocks you own going down, if you're sitting there getting frustrated by it, then you're looking at it all wrong. We're going through a phase that's setting up tremendous opportunity. It's not necessarily today, although there are some very enticing buys in the Australian small cap market. But the opportunity should be very, very good. So let's look at American stocks now. The S&P gave up 1.6% for the week. and even options expiry on Friday under normal circumstances, with so many in the money put options, it's really advantageous for the market makers to have engineered some rebounds on Wednesday, Thursday, Friday, just to reduce the amount of money that had to be paid out on all these in the money put options. But in actual fact, the closes on an individual stock level on both Thursday and Friday were really negative. They were really on their lows. So even options expiry didn't save it. So that tells you something about the sentiment in the market. Now, the big question is, which I want to explore, is how will the big tech stocks fare from here? They've not fallen nearly as far as other parts of the market, which is normal. You know, in a market correction, small caps go down first, then the mid caps, and then last to go down are the large caps. And of course, that then has the biggest impact on the indices, because the indices are heavily influenced by those stocks. So that's really the big question that I want to explore in this week's edition. The US dollar was up a little bit, 96.1. The yield got above 2% last week, but finished steady at 1.93. And the VIX is still bouncing around in the mid 20s up to 30, and we finished at 27.7. So still elevated, but not super high. And the VIX is certainly an indicator, or one of a number of really important indicators that'll tell us when there's a better buying opportunity. That's for the market in general, of course. There'll always be individual ones along the way. So let's look at the S&P. You can see we had a bit of a bounce on Tuesday and Wednesday, but Thursday and Friday were pretty negative at the index level. We've got key support here at around 42.60. That's a pretty critical level, and that will that will trigger some technical selling if it gets breached. And I expect at some point in the next either week or month that this level will get breached. There's just too many boxes getting ticked for that not to occur. But the other thing to remember is that corrections, and in fact there was a correction of sorts during 2021, and it was on a sector basis. So we had this rolling correction from sector to sector, where sectors would be in favour and then they'd get sold off and money would rotate somewhere else, and individual stocks were getting their correction in price, but it wasn't really that evident at the index level because it was just money rolling from one sector to another. It's possible that the S&P index may not fall that far, but we still get this rolling rotation correction, so that at the individual stock level, you're still going to see the same level of decline. But you've just got to keep your mind open to all the eventualities at this point in time. Now, importantly, let's jump into some of the spread charts. So this is consumer discretionary versus consumer staples. We had a little pause, which is normal. So sharp fall, bounce, another sharp fall, little consolidation, and the trend is down. There's nothing else you can say about it. So that is a market that is going risk off. This is small cap growth versus small cap value. Same deal. So we're heading down again. There's been no change in trend. This is the Russell 1000 growth, or larger cap versus 1000 value. Exactly the same. You can see how we finished the week, quite negatively. So the rotation from growth stocks to defensive stocks, or so-called value stocks, is still going full steam ahead. This is the Nasdaq versus the S&P. So this is reflecting the weakness in the bigger tech stocks. Are obviously in the Nasdaq, whereas the defensive consumer staples giants, for instance, are in the S&P. So that is also telling us a story. But the other key one that I want to look at is these three indices here. So this is the Dow Jones Large Cap Growth Index, DJU SGL. Now, what I want you to pay attention to here is the relationship of the three moving averages. The green one is the 20-day, the blue one is the 50-day, and the red one is the 200-day, and the price in relation to those two. Now, if you look at the largest impact on the indices comes from this group, the large cap group, and they haven't really let go yet. Now let me just go back to the S&P. So just take note of the fact that this little decline here in January only went to roughly the same level as the decline in October. So they were about equal. And if you drew a line across there, it's a horizontal line. But if we go back to the large cap index, you can see that line, that this low here in January is lower than the one in October, and the connecting line is actually pointing down. So that is telling you that the large cap growth stocks are doing worse than the S&P, which, there should be no surprise there. This is just validating the point. But if you look at it compared to mid caps and small caps, then this group, yes, it's worse than the S&P, but it hasn't really let go yet. And if this level breaks here, then I think you're going to see some more significant selling. So it's already underperforming the S&P, but it's doing much better than if we look at DJU SGM. Then you can see that's very, very significant. So here, the blue line, the 50-day moving average, is still above the 200, and the 200 hasn't rolled over yet. But if we go to the mid caps, you can see the blue line is below it, the 20-day is well below it, and the 200-day has started rolling over, and that's as you would expect it to be. And then we go to the small caps, and it's even worse. So it's very clear how the market correction is playing out. Small caps first, mid caps second, and then large caps haven't really got into the decline yet, and may not. The support may come in for the Apples and the Microsofts and those sort of stocks, Googles, but if the market decides to contract the multiples of those companies as well, then we haven't really seen the main part of the decline yet. I guess that's the point that I want to make. And just to put a final graphical representation on this is those three indices: large caps on top, mid caps in the middle, small caps at the bottom, starting 12 months ago at a common point. So they all started, this chart has been adjusted, so they all started at the same point. The large caps outperformed, but so far they're not really doing worse than the others, but that could well yet come to pass. So they're the key charts that I wanted to look at. So pretty much this is playing out as per normal in the US. There's the US currency, not a lot of change. It's really just bobbing up and down between a little bit under 95, 94 and a half, and around 97. If we look at the Australian dollar, it's all purposes, it's pretty much the mirror image. Now the other, I'll come back to the energy chart later. So with Aussie stocks, our dollar finished 71.14. Our index was flat for the week, but again, I think we can expect to see selling on Monday, as we did last Monday. And the big swing factor in the Australian market has been the healthcare majors, particularly CSL, which is, I think, the number 2 or number 3 largest cap stock in the Australian market. Going back a couple of years, I think it was the largest. But CSL has been sold off in a big multiple contraction, not because there's anything wrong with the company, but it's been expensive for decades. But then it rebounded partway through the week and rebounded spectacularly, and then closed down again quite firmly on Friday. So CSL is having an outsized impact on the healthcare sector. Banks were pretty stable, as we'll see. Resources positive. So, that's pretty much the setup in the Australian market. So we'll just take a quick look at all those. So there is the ASX 200. Certainly some selling on Friday, but I would expect we'll get more selling and we'll probably be back down below this support level on Monday. Energy in Australia has done well in relation to other sectors in Australia, but when we compare it with the US, it's absolutely chalk and cheese. I'll come back to that. Finance has done reasonably well, and in a rising interest rate environment, you would expect the banks to do okay, but it's the healthcare that's really been the huge roller coaster. So we can see we had this very significant sell-off, and then a bounce, another sell-off, another bounce, and then very negative again on Friday. So healthcare is just all over the place at the moment. And this is materials, so BHP, Rio, Fortescue have been generally pretty solid. Now, the key thing about the Australian market in particular, far more so than the US market, is that it's almost certain we're in a commodity super cycle that'll continue for another 5 or 10 years. We were quite possibly going to get that anyway, just because of the economic cycle. But with decarbonisation demand for minerals thrown over the top of that, it almost makes it a guaranteed situation. So therefore, if you want to know where one of the mega trends are, then you don't need to look too much further than nickel, copper, lithium, graphite, etc. And whilst they've gone up a lot, particularly lithium, there's still a long, long way to go. So the rest, in terms of making money out of the commodity sector in Australia, is really, what is the plan you're going to apply to it, and how many stocks are you going to own? How are you going to weight them? How are you going to enter? How are you going to take profit? All those elements of your plan needs to be clear, and then just the discipline to try and buy things when they're being sold off, and to perhaps take some profit when they're shooting up, rather than get greedy and want to try and gather some more. So if you can do those things, then you should do pretty well. Precious metals, gold has had a very good couple of weeks. Obviously the Ukraine situation is feeding into that. It was up by another $38, almost to 1900. But the question is this a move just because of the tensions around the Ukraine and the possibility of war, or is this a move where the Ukraine situation is only contributing part of it, that gold is going up because of all the economic factors, the massive amount of debt around the world and all those sort of things? I've got my money at the moment, until proven otherwise, on the fact that this is really just a Ukraine situation, because gold has had so many opportunities in the last 5 to 7 years to go up. We've had these massive debts and massive deficits and bloated balance sheets of central banks for years and years and years, and the gold price has failed to respond. So, why now, would be my question. Perhaps it's related to interest rates going up, but generally that's a negative for gold, not a positive. So my money at the moment it's just on Ukraine. And of course, then the danger of that is that if Ukraine reaches some sort of diplomatic settlement or a bit of a back off on the part of Russia, then the price of gold is going to come back down pretty quickly. So that's the danger in gold, that if it is mostly or all about Ukraine, then you've got an unpredictable situation. If you look at lithium, we know the demand for lithium is off the charts, and they're probably not going to catch up for 5, maybe 10 years. But that's not the case with gold. That the demand for gold, at least in the speculative part of the market, could evaporate tomorrow. So that's the risk. Now, if we look at precious metal stocks, it was obviously a buoyant week. but we're coming from the bottom of the channel, the trading channel. So I'm not getting terribly excited about it. The stocks, and I own a couple of gold stocks in Australia, but they're stocks that don't require a rising gold price to do well. They're just outstanding projects that are going to get valued higher, probably significantly higher in the future, but they do not require the gold price to go up for that to happen. So I would encourage you to try and look for those sorts of stocks. Okay, so let's have a look at the gold price. So we'll just check in on Bitcoin. So Bitcoin, we've had a bit of a bounce, and we're still just holding above the 40,000 level, but it's certainly well off the highs that we saw in November last year. So there's the gold price on a daily basis. You can see we've had a good couple of weeks, but when you look at it on a weekly, we're still really within this overall big picture consolidation. So the peak was in August of 2020, so that's 18 months ago now, and it's a fairly long consolidation. We really need to get above this level here, which is about 1920. I think that would start to get people interested again in the gold price, probably bring a lot of speculative buying into the market. Silver also not really doing much different at the moment either. Now, if we look at GDXJ as a proxy for gold stocks, we're still just really sitting mid-range. We've only just come off the bottom, so there's nothing terribly exciting about the gold stock indices. The 200-day moving average is still heading down. GDXJ is still below it, so's the shorter-term moving averages. So, there's not a lot to get excited about in that gold space at the moment. Turning to other commodities, copper was up to 455, which is not a bad effort considering that the US dollar was up a little bit. But nickel is really surging, and it's up over $11 now. And it's about inventories. I showed that last week, and I'll just update those charts, plus show you a longer-term chart as well on nickel inventories. Crude oil came off a bit. We got up to 93.5, 94. That came back to 91.5. The long-term undersupply situation now looks to be a given. It's hard to see there's going to be the level of investment in oil and gas exploration that would bring this back into line, supply and demand back into line. The world just doesn't have an appetite for doing it. Banks don't want to lend. There's so much community pressure now that it's hard to see. So I've been slow and I've been behind the curve on crude oil. I've never been a fan of crude oil for decades, because to me the price movements were so much about geopolitics that were unpredictable, and so that's why I've dragged my feet on the energy sector. And I've got to admit this time I've been too slow. But I've got to acknowledge now that the long-term fundamentals, anyway, really is supportive of an oil price in excess of $100, and quite possibly well in excess of $100. And I don't think it's stupid to talk about $200 in a few years' time, because the supply-demand situation is really getting quite serious. Geopolitics. So that's the long term. I think that's a mega trend, I believe, of sorts. Now the overall usage of oil might come down a bit, but the supply is going to be such that the price is going to be quite buoyant, which means that the companies still participating in that area are still going to be able to make very good profit margins. Now, geopolitics, so what's happening with Ukraine, or what OPEC does with raising or lowering production rates, or all those sorts of things, they have temporary and unpredictable impacts, and that's the thing that's always made me very wary of the energy sector. And they'll still be there. So we've got this long-term supply situation, and then we've got geopolitics over the top. So we do have an unpredictable situation still in the oil patch, but it just tells me that there's got to be opportunities. I'm not 100% clear in my mind how to best use that, but I guess you wouldn't want to be jumping into the energy sector before we see some sort of corrective action in that sector, because it really is pretty hot, as we'll see from the charts. In fact, let's just go and do that now. The first chart that I just want to look at is the Australian energy chart. So this reflects Woodside, Santos, Oil Search, etc. So just have a look at, this is the COVID crash in 2020. So we were up here around 12,000. We fell to 5,000. And now we've stabilised pretty much from the middle of 2020 at this level, which is, call it the midpoint, probably about 8,500. And it's really been at that same level with no uptrend. 200-day moving average is flat, maybe just starting to kick up just a tick. So keep that in mind, but we've only recovered 50% of what was lost in the crash, and we're not trending. Now, if we go to the US market, however, then it looks very different. So this is the COVID crash. We're now actually at new highs in US energy. The Australian market relatively would be down here. The 200-day moving average moving up very strongly, and the shorter term moving average is doing the same. So it's absolutely chalk and cheese between the Australian energy sector and the US one. So if you're looking for opportunity, then the first thing I would say is you've just got to go to the US energy sector compared to the Australian one, and it's just all there in that chart. The second point that I would make is that when oil prices rise, then of the three sectors of the energy complex, which is upstream, so oil and gas production, midstream, which is the transmission of product, and then downstream, which is the refining process, history shows very, very clearly that when oil prices go up, it's the upstream stocks that do significantly better than the rest of the sector. So you've got to conclude that if you want exposure to the energy sector, then you've really got to go to the US oil and gas producers / explorers or developers. But I'd probably stick with the producers, because you're not dealing in the future here. The oil price is high right now. You want to be in stocks that are capturing that profitability. Okay, there's the spot copper chart. So you can see not a lot of change in the week, but there's nickel up above $11 and looking very, very strong. And there's the 5-year spot price. So that gives you a much clearer picture. And if we look at inventories, that's the 1-year inventory. So maybe starting to flatten off a little bit, but boy, it's at a pretty low level. And I thought I had the 5-year as well. So when you look at the 5-year, we're down, certainly down to historical low levels in nickel inventory. So it's going to be hard to catch up the supply and demand there. So wrapping it up, my final thoughts are this is an absolutely textbook decline in my view. It's just progressing the way that you would expect it to, and because of that, it becomes somewhat predictable. I say somewhat because on a day-to-day basis, it's a real washing machine. We're down one day, we're up the next. So if you get your nose too close to it, you would think that it's not predictable at all. But when you stand back and you look at some of the bigger picture things that are going on, it really does appeal to me as being very predictable. And that's important because that gives you confidence to pull the trigger in the next phase. So it'll be very good, I think, for those that are organised. If you're not organised, if you tend to just jump into the market on a whim, or you follow tips or whatever you do, then all bets are off. I don't know how you're going to go. But if you're organised and you're on top of things and you've got the discipline to pull the trigger at advantageous times, I think you can do extremely well out of this. I'm still on the lookout. Whilst I expect the S&P will probably break that support level and work its way down towards 3,800. But I'm still open-minded enough to look for a rotation correction more than an index correction. So it may well be that the S&P doesn't fall that far, but we're seeing it in individual stocks. And if that's the case, then you really need to be, watching your targets all the time, because you don't want to just wait until the index bottoms and turns up, because the opportunity in the stock that you were interested in may have occurred months before that. So, there are opportunities in the Australian market right now. There'll be, a couple of stocks that I'll be very interested in buying even next week because of what their charts are telling me. So I'm not necessarily waiting for this index correction to play out. Portfolio analyst last week spent a bit of time on how my portfolio is constructed in terms of weightings and how I'm entering and exiting. We looked at gold and lithium stocks. We also looked at several small, therefore high-risk, early-stage projects. But those sort of projects, whilst they're high risk, it's okay if they're only a very small weighting in your portfolio. So you don't have to avoid those sort of stocks. You just don't want to have big positions, and you don't want to have a whole bunch of them as well. So it's all how you compose your portfolio. So that's it for this week. There's more information on the website. There's my email address. And, we just got to know that this is going to be a very, very eventful week. I think this is going to continue for months. And, opportunities will keep coming through. So I'll be back with you next Sunday. Cheers.